Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. April is Financial Literacy Month, and we will be covering a wide variety of topics to support the cause. Joining me is Caleb Silver, editor-in-chief at Investopedia, to discuss the basics of a bull and bear market and what they mean. So let's start there, Caleb, with a very basic definition of what each one is.
Sure. And people throw these words around all the time, Jill, but it's great to just have a fundamental understanding of what they are, especially if you're just beginning to invest for the first time. A bull market, that's when asset prices are rising generally as a group. It's when a trend of higher highs are coming in. It's usually off of a 20% decline. So when stocks rise from falling after 20% and then an additional 20%, that climb up. When they reach that 20% threshold again, that's the definition of a bull market. And a bear market is the opposite. It's the trend when asset prices are falling in general. Usually a fall of 20% from the most recent high is considered a bear market. And we've seen more than a few of those in the last 20 years for sure. But that's the definition. That's really a sentiment thing.
And are these more secular or cyclical in nature?
Sure. So a secular, when you hear somebody talking about a secular bull market, they're talking about big trends that usually play out over years at a time. So think about demographics as a secular trend. Think about people moving in from cities into rural areas as a secular trend. Think about the digital economy. That's a secular trend versus cyclical, which could be driven by economic forces that are happening because of maybe a downturn in a certain part of the economy or a disruption like we had with the COVID pandemic. That created a cyclical bear market, a very quick one, but it's not secular. It doesn't last for generations. It comes in and out very quickly. So that's the difference between a secular bull or bear and a cyclical bull or bear.
And Caleb, actually, if we take a look over the past century, there's more bullishness with just some pockets of bears in there.
Sure. I mean, we've been in a bull market basically for the last 20 or 30 years with some bears, some nasty ones, but we do have these bear markets that pop up around every 56 months or so. So not that often, but when they come hard and they scare people. That's why they're called bears. But most of the time, stocks are usually in an uptrend or have been for the better part of the last century. And that's the reality of things. So if you're always worried about a bear market, you're probably going to miss all that upside because stocks generally return about 8 to 10% a year on average.
And Caleb, to wrap up here, how would you behave in either a bull or bear market?
So when you're in a bull market, it's a time to be aggressive, but not overly aggressive. But you want to favor stocks because that's what usually performs well in an equity bull market. You want to dollar cost average your way into stocks or ETFs or the securities you want. So you can't buy it all at once. You can't buy all the stocks you want at different prices, but you can buy a little bit every month. So you dollar cost your way in to get those prices as they go up. And then don't try to time the top. Keep it steady. You're never going to know when the market's going to reach its top. But if you keep buying and you have a plan in a bull market, you should be fine. And then look for opportunities to take some profits when you can and reallocate to other parts of the market. When you're in a bear market, it's a completely different stance. You want to be more defensive, but you don't want to panic sell. The last thing you want to do when stock prices start falling out of the sky is sell everything because you're going to miss the pickup again. Rebalance your portfolio if we're in a bear market to make sure you're not exposed to sectors that might be more vulnerable, and look for opportunities to buy back in at cheaper prices because the best thing about a bear market is that they end and you could buy stocks at a discount and enjoy that upside on the way back up, Jill.
Caleb, thanks for joining us for Financial Literacy Month, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.